Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build Washington, D.C. housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, best number to reach out to us is our off-air number. It's 877-245-2030. That's 877-245-2030. Or visit us via the web at realestate360live.com. It's realestate360live.com. So it was an interesting article, actually, in Bloomberg today that the Treasury is going to start auctioning off shares in the 12 bailed-out banks. Per the article, the U.S. Treasury Department said it started selling stakes today in 12 banks that received taxpayer funds after the financial crisis, as the administration seeks to wind down its crisis-era bailout programs. Long and short of this article is that they're trying to unwind the program, I guess, because they're trying to get back as much of this taxpayer money as they can before the election. At least that's what the article is hinting at. Obviously, under the TARP, the originally approved by Congress was a $700 billion program to rescue financial institutions. The Treasury put cash into banks in exchange for equity stakes. Many of the bailout recipients repaid TARP funds plus interest payments on their preferred shares, but many of these smaller banks are going to be unable to repay. So I guess they're basically selling off shares of 12 banks trying to recoup a bunch of money. It is interesting that it's taken this long to start doing this. I think it's funny because they're saying that, the taxpayers have profited some $20 billion from this bailout. But at the end of the day, where's that money going, Louis? You know what I mean? It's not coming to the taxpayers.
It doesn't get returned to the taxpayers, right?
Right.
Also, you have to look at the full ledger. What about all the money they lost on Solyndra, General Motors, and other companies?
Well, yeah, that's the article went deeper into. They also still have stakes in General Motors. They still have stakes in IAG. I think they were at 97% owner. Now they're like a 66% owner in those companies. I mean, how long is it going to take to wind down those companies?
It's ridiculous to think that somehow the government's going to invest your money and you're going to get a positive return.
Well, yeah, it's always funny.
Justification, it's self-serving to say that somehow the bailouts made the investors money. I mean, it's more genuine to say that they saved the banking system if they want to take that argument, and not that somehow they made the shareholders, mean the taxpayers, money.
Right. It's always there. Anytime you hear anything about somebody paying back money, it's always, the taxpayers are getting their money back. Well, really?
I didn't get that check.
Yeah, I didn't get one either, and I don't see it that way at all. I mean, the whole TARP bailout was to bail out these banks. It wasn't, the intentions were not to help benefit the taxpayer. That just wasn't the case.
Money for the taxpayer.
Right. That's absolutely not the case, and I think it's ridiculous when these. I mean, a lot of the reports and articles are written that way. Because I was a big proponent to not do all that. They're saying, well, what would you have done? If you don't bail those out, you have to let firms fail. You have to let people fall on their face and pick themselves back up. That's what the normal average American is expected to do. So why are they above everybody?
You're basically rewarding their incompetence, and therefore the market doesn't correct it because you have the same people who ran the bank into the ground, made the wrong decisions, still making the same decisions.
And we've seen we still have banks making very risky bets and decisions now. The
only reason they make them is because it's implicit that they're too big to fail and that there's not really any competitors around because they're regulated out of existence, and that if something does go wrong, even though they said they're not going to do bailouts, they'll create some way to get the bailout.
Right.
I mean, remember, the Fed can bail them out and no one would know that they did it.
Yeah, I mean, it's a sad state of affairs, but you can just tell these big banks they continue to do much of the same. I don't think much is going to change.
Look how they nickel and dime you on those. A real competitive bank would not come after you for all of these fees that they have.
Yeah, for the ridiculous overdraft fees and the I mean it's
they know where you're going to go.
Right.
You go somewhere else. It's your money's not secure there. It's not FDIC. you got to stay with Bank of America. You have to stay with J.P. Morgan Chase. There's very few of them left.
Yeah, and that's why sometimes the only other way you can go, Louis, is to try to find a credit union that's, been around for a while. Because sometimes they do give more benefits back to their customers, and they don't exactly have the same regulations.
They don't have the clout in the market. Look, if Starbucks, every time you went in, started charging extra money for sugar, people would leave that place pretty quickly.
Well, although their prices are pretty high to begin with.
They are, but at least they view their customer as trying to serve their customer.
Yeah.
Putting price aside.
I personally don't buy coffee from Starbucks.
I don't buy coffee there either, but there's enough people that are loyal to Starbucks because they feel they're getting a fair deal there, even though they're overpaying for their coffee.
Yeah, and I think, I think a lot of people just don't really care about necessarily the bank that they're banking with. They're banking there maybe because of the convenience of the location of the bank. You know what I mean? And it's, I guess it just takes enough angry people to finally, because that's what happened last time. I think with some of their overdraft fees and things like that were deemed, and credit card fees and everything else that have been thrown into these other regulatory bills. But it's pretty sad when they feel like that they have to take advantage of the consumer even more when they're already making money hand over fist.
They can do it, but what I'm highlighting is that there aren't really a lot of alternative banks. If there's an oligopoly and they're all doing it, then there's really nowhere to go. If all banks charge these ridiculous fees, all the large banks.
Yeah, the large banks do, but you do have options. I mean, I don't bank with any of the big banks. I bank with smaller community banks, and they're the ones that actually have where I can go to, up to 10 free ATM fees no matter what bank I go to. They'll refund me whatever that ATM fee was. So, I choose that because I'm able to walk into the bank and I can meet these people in person. Now, do you have more flexibility? Or I think that I do because they know me. They know who I am. I just feel like that the overall business community doesn't really take that approach. And I think they should. I think that this should get out there because I do know now, especially in the real estate market, there are banks in the Washington, D.C. metropolitan area right now that are still looking for investors that want to buy homes and want to put 20-30% down. They're willing to fund those deals. Now, they're not they don't have the marketing budget to be pushing that out there on TV, radio, and everywhere else. And that's why I feel like they kind of get lost in the shuffle. Now, are they going to be maybe more conservative? I don't think so. I think they're more aggressive than the bigger banks.
They need to be to make money.
Right. They actually have these relationship managers, believe it or not, that the big banks don't have. They don't need them. They don't care. So there's people that are out there actively looking for businesses to work with and to do loans, and versus your Bank of Americas and your Cities and your J.P. Morgans, they could care less. They're just
that's good to hear, Ryan, that there's actually competition for these banks, and if the free market works, eventually the banks that do provide a better service, better everything overall service, that they'll do better than the large banks, even though the large banks may be wards of the state.
Yeah, no,
I mean, look, it's the post office, right? That FedEx does a better job of delivering your packages than the post office does.
Right. Yeah. And people are willing to pay for that because they're getting a better service. It's interesting. I know you're on the West Coast, Louis, so I'm not sure. Like, is it predominantly just bigger banks out there on the West Coast? You don't really have many small credit unions?
In my area there are some small banks, but I've conditioned myself not to trust them, which is probably ridiculous.
Right.
Why would you trust the larger banks? But most of the banks in my area are the J.P. Morgan Chase, Wells Fargo, Bank of America, and so on.
Yeah, and I think you highlight a good point because, see, it's embedded into a lot of people's heads at this point to only trust them. And,
because if there is something wrong with Bank of America, J.P. Morgan Chase, that politically they will bail those out before they bail out the Southwest Bank of California.
It's pretty sad that we have to think that way too, isn't it?
Right.
And that's where I'm. I would just tell everybody, kind of spread your money around and don't ever put more than what the FDIC limit is in any one bank, because you never know what can happen ultimately.
You got to be lucky enough to have over $100,000.
Yeah.
Not that problem.
Yeah. Well,
is that the amount? Is it?
It's $250. It's $250.
Yeah, but wasn't that temporary? That goes away?
It's still there as of right now. Yeah, obviously any of these things can go away, and I would imagine in a heartbeat it might go away if some sort of economic catastrophe took place. But then again, a lot of what the FDIC does, there's been banks shutting down left and right. Almost every single day there's banks that shut down. But when they shut down, what happens is the FDIC doesn't absorb all their losses. Typically, they have all these loss share agreements with the new banks that are buying them.
Right.
And so, they're really never recognizing all these losses at once, just they're having another investor come in and take over their deposits, and they get stuck with, holding these bad loans, which the FDIC basically shares a portion of their losses with them. So, that's why I kind of am always like, well, as long as there is some sort of insurance there with the credit union or whoever it may be, you are, somewhat safe. However, I don't know. I just, like you said, Lewis, I've conditioned myself to stay away from those banks just because I think it's more of an issue I have with dealing with them. They don't care about their customers. You know what I mean? And my hope would be that, more of these smaller banks start to prop up and really take the stance of, we want to help. And I think the other issue,
the cost of regulation of starting a bank has got to be astronomical.
Well, yeah, and that's the part of the problem too. There's so much regulation now, Lewis, that it's not just as simple as them wanting to go out and attract new clients to do loans for, because there's so much regulation in place that if it's not this, and this, they can't even consider giving them a loan. I mean,
They can't even open their business without an enormous amount of cost.
Right. Well, gone are the days where you're a business trying to start up or survive, and you've got money in the bank, and you're looking to expand, and you've shown a history of 5 to 10 years of a successful business, and the bank, they know that you've been in the community for a long time, and they want to see you expand, so they give you a loan. No, it's, okay, great, your tax returns aren't exactly what we wanted them to be, so you're not going to get this loan. It wasn't like that 5 to 10 years ago. And
5 to 10 years ago, maybe lending standards were too loose.
Yeah, and you know what? I feel like that they probably were definitely too loose. But my thing is that there's also should be a sense of what I call common underwriting sense. You know what I mean?
Market driven rate.
Sure, you got $1 million in the bank and you're asking for a $300,000 loan. What's the issue?
How much do you charge for that?
Yeah, should you be allowed to charge a premium for that because the tax returns aren't exactly what they need to be in your qualifying ratio? Sure, but
taking that risk, right.
there should be a market for that. And like right now, what we're seeing is that the interest rates are just super low, around 3.5%, 4%. And if it doesn't meet the criteria and you can't get the 3.5%, 4%, you're not getting a loan. Period. End of story. It stinks, but that's where we're at right now. We're coming up on a break. When we come back, we're going to jump into why you should short sell if you're the seller, the advantages of doing that versus letting your home go to foreclosure when we come back.